Joining us is a very special guest, exclusively on ET now, S. Nagnath, President and CIO at DSP BlackRock Investment Managers. Mr. Nagnath, thank you for chatting with ET now. First up, what's your sense? How do the markets look to you at this point in time? Do you believe that we're attractively valued, or are you factoring in a possible correction at these levels?
Well, I think for 2013 we're bullish on equities. We think that economic growth rate will accelerate to about 6.5% in the financial year 2013-14. That is April 13 to March 14, led by a revival in investment spending and a uptrend in consumption spending. We expect corporate earnings growth to move up to about 14 to 15% in the next financial year, from about 9-10% or so in the current financial year. And therefore we think this will underpin strong performance by equities. Near term, we think that markets around the world could see a mild correction, maybe 5 to 7% or so, given the strong move in markets around the world since late last year. But in India, we expect that as we get into March, April, we see a nice uptrend developing in equities, which may well continue until the fourth quarter of this year.
Mr. Nagnath, afternoon. Just talking about a slightly longer term as well, what are the levels that you're envisaging for the Nifty as well as the Sensex?
Well, it will be difficult to pinpoint any particular index level over the medium to long term. All I can say is we're very optimistic about the economic growth momentum being maintained, not just in fiscal 14, but also continuing into fiscal 15 and fiscal 16, led by a significant upturn in investment spending that could well take our GDP growth rate to 7 to 7.5% in fiscal 15 and possibly even a little higher in fiscal 16. All of this may well contribute, in our opinion, to corporate earnings growth moving up to about 14-15% next financial year, and then possibly to about 18% to 20% in the two financial years that follow. If this were to happen, then I think you could see the overall movement in the index to be quite good over a 3-year period, and it's quite possible that this steady uptrend in economic growth and robust recovery in corporate earnings growth could also result in the PE multiples, which are currently around 14 times for the Sensex index, moving up possibly closer to about 17 or 18 times over a 3-year period, in our opinion.
Right, flows have been massive last year, especially foreign fund flows, and also in the last couple of months. Despite this, markets are absolutely range bound. Do you think, foreign flows are likely to taper off over the next couple of months?
No, I'm quite optimistic. I think across the globe we're seeing signs of a good economic recovery taking shape. The US economy will expand quite nicely this year and next. And we think that flows into emerging markets should continue to remain robust. As far as Indian equities are concerned, I would not be surprised if we see another year of $25 billion or more in terms of flows for this year.
And what about oil and gas? Now, oil as a sector has seen the most reforms over the past few months. Do you like this sector?
Well, we think that oil prices will decline later in the year based upon new discoveries of oil and gas across the globe, and the uptick in prices that was seen in the last few months should moderate, and we should see prices of oil decline, as I said, in the second half of the year. That, I think, would augur well for the oil and gas sector here, and therefore I think the outlook for that sector relative to its own performance in the last year or two should be much better in the year ahead.
What about the IT sector? That's moved, one way after Infosys announced its numbers this quarter. Do you think the worst is behind the IT sector?
Well, as the US economy begins to pick up momentum in its growth, I think you will see the business pipeline for the IT companies also begin to look much, much better. So again, as we get into the second half of this year and beyond into 2014 and 15, I think the outlook for IT companies looks good in my opinion.
But what about metals then? After a huge rally over the past few months, that pocket has also tapered down. So can we expect some consolidation given that the results have not been that great?
As I had mentioned earlier, based upon our outlook for a global economic recovery to gather momentum by the middle of the year into the second half and into next year, we think that industrial commodities and metals will start to do well from the second half of this year and into next calendar year.
And what about banks? Do you prefer private banks, or do you think there's value at as far as PSU banks are concerned as well?
Well, banking as a sector looks very good. It is clearly tied to the growth rate of the economy, which we think will accelerate as we progress through this year and into next and into 2015. So, if it's a choice between private and public sector banks, I would say both look good. Relative price performance may vary from one quarter to another, but I think both private sector banks and public sector banks should look forward to expanding demand for credit in the next quarter and thereafter, and I think that in turn will augur well in terms of margin expansion for banks as a whole.
So do you think any bottom picking is possible in infra, realty or the capital goods sector, or will the debt overhang remain here?
Well, we think that as investment spending picks up as we get into the new financial year, the capital goods infrastructure sector, I think, will see a lot of investor focus. There are companies in that sector which do have a large amount of debt. Now, so long as an investor is convinced that the companies will be able to manage the debt servicing, I think a lot of stocks in this sector, in capital goods infrastructure, ought to do well in my opinion, but then one will have to be a patient investor here and take a 3 to 5 year investment horizon into account.
Will you back pharma in an otherwise subdued market?
Pharma, if you look back at the last 5 to 7 years, has done well as a sector. And I think that will continue to remain the case over the next 5 years or so. One has to take a company-specific look when one invests in the pharma sector.
And how long do you think it will take for demand to pick up in the auto space?
Auto sector demand, I think, should begin to pick up into the next financial year as interest rates come off and later in the year as oil prices come off. I think the demand should come back quite strongly for the auto sector in our opinion.
And finally, we're just days away from the biggest economic event of the year, the Union Budget. What are you expecting from the Finance Minister this time around?
Our view is it will be a pragmatic budget and not a populist budget, and that it will focus on getting growth back on track and especially getting investment spending to gather momentum. So all in all, we think it will be good for the financial markets.
Mr. Nagnath, thanks very much for chatting with us exclusively on ET Now and sharing all your thoughts on the various sectors for the Indian markets.